Welcome to the video digest of the State of the Agri-SME Sector Bridging the Finance Gap briefing. This event took place in March 2022, and this briefing covers all sections of the report. We're grateful to our colleagues at SAFIN, the Smallholder Agri-SME Finance Network, for hosting the workshop from which this briefing was taken. The presenter is Jérôme Van Innis, one of the team of report writers from ISF Advisors. The State of the Agri-SME Sector Bridging the Finance Gap report can be downloaded from the CASA website.
As you will see from the initial executive summary, this report is, I would say, quite extensive, and we have tried to cover quite a lot of ground. So in this specific presentation, we want to focus on the 4 change priorities, which are the recommendation to really push forward the envelope on the agri-SME finance sector. What I want to do, I want to start with a bit of an introduction of the report and a bit of an introduction on the current state of the sector. So this report essentially builds on past research conducted into the agri-SME finance market by a range of actors over the last 5-10 years in particular. Actors such as Convergence in blended finance, SAFIN, of course, CASA, CSAF, ISF, and a number of others. And this report really is intended for investors, capital providers, intermediaries, and governments, among others. It's intended to provide them with a global viewpoint of the agri-SME finance market, and also to propose some clear areas to pursue and closely watch in the future. This report is structured into 5 sections. The first one, we start with painting a broader picture on the state of the sector, and there's usually quite a lot of demand on that. Also, we try to size the current demand and the current supply, as well as obviously the gap for agri-SME finance in the 2 regions of focus, which are Sub-Saharan Africa and Southeast Asia. And by the way, that excludes India, just as a note, important note. The second section, in the second section, we really unpack the demand in much more detail, and we try to provide a more dynamic approach to segmenting the agri-SME. Again, based on the work that SAFIN and ISF did in the past with this new segmentation. This allows us to understand their growth pathways and their investment profile, as well as their financing needs in a different way. In the third section, we map the supply of financing from capital providers to financial service providers and intermediaries down to the agri-SME. So these allow really a much more granular understanding of how the market is currently supplied and currently being served, and where the key gaps exist in terms of not only debt or equity, but also in terms of types of SMEs within the market. In the 4th section, we look at blended finance in much more detail, because blended finance really underpins much of the agri-SME finance market. And we try to do a couple of things. We try to provide a much more sophisticated view on the landscape of blended finance approaches. We try to identify potential gaps and also suggest a few ways forward to make smarter use of scarce subsidies in order to create more impact and support the future development of what we call commercially sustainable local agri-SME finance markets. So these are the 4 sections, and finally we conclude with 4 change priorities. So I want to start first quickly with the state of the sector, and briefly, I don't want to delve too much into the context, but as we know, over the last decade, there has been increased attention, focus, investment into the sector. On the one hand, obviously, to try and deepen the learning agenda, to try and deepen our understanding of the sector, but also, on the other hand, to try and create new funding structure, new funding mechanism, new specialized financial intermediaries in order to complement the local financing landscape, which is made of local banks and government-backed lending program. But while a lot of progress has been really made, the access to finance still remains a major problem, as witnessed by a significant gap between the demand and the supply. So what this report aims to do is to really take stock of the agri-SME finance market in these two regions and to establish a new perspective. And there are really three things that we emphasize in this report. The first one is sizing and segmenting the market in a new and more dynamic way, shall I say. The second one is reflecting on the rapidly accelerating imperative around climate, particularly on the back of the last COP26. And then the third element is trying to identify new priorities for action. So it's really important to think more broadly about what is needed to move the needle on the agri-SME finance. With this context, we wanted to start not anchoring, but provide a bit of a context to the discussion. And with all its flows, we have done an initial estimation of the current demand and the current supply. If you recall, in 2019, as ISF Advisors, we published a report called Pathways to Prosperity. And this report provided a snapshot of the rural and agri-SME finance market, with particularly a focus on smallholder farmers. And this report had a slightly different geographic focus in that we also included Latin America, but we estimated in 2019 that the financing gap for smallholder farmers to be around $170 billion. 2 years later, what we've done is we've focused really on agri-SMEs only in two regions, and we have estimated that about 220,000 agri-SME have a demand of about 160 billion. 90 billion in Sub-Saharan Africa, 70 billion in Southeast Asia. Again, this number is smaller. We've excluded India, which in itself is an extremely large market, of course. If we look on the supply side, and based on our estimation, we notice that only a third of that demand is currently being met. Only 34% of this is being met. And the picture is actually even bleaker for Sub-Saharan Africa, where barely 15% of the financing demand is currently met, while in Asia, about 55% is currently met. So there's definitely a strong difference between the two regions. What is also interesting is we then conducted a bottom-up sort of estimate of the current supply, channel by channel. And interestingly, the bulk of the current funding, about 75%, is supplied by a local commercial bank. But again, there's a strong difference between the two geographies. This is particularly true in Asia and less so in Africa. And this channel mostly tend to focus on more mature agri-SMEs, the likes of established aggregators or processors. The second and third channels are your non-banking financial institutions and your public development bank, which provide an estimate of about 20% of the current supply. And for all their efforts being at the forefront of agri-SME finance innovation, social ladder and impact-oriented fund provide about 3 billion, so less than 10% of the current supply, but they are predominantly focused on the Sub-Saharan African region. And finally, the last, but I would say not least interesting source of supply are the private equity and venture capital fund, which focus very much on the top of the market. Either these very large mature SMEs that have stable cash flow and have growth potential these are interesting for private equity funds, or the fast growth, disruptive agtechs, the likes of, we heard recently, Apollo Culture raising a Series B of $40 million. So the likes of these players that are particularly attractive for venture capital provider of capital, sorry. So that's the initial sort of number. But if we dig beyond the number, this report really tried to introduce a more specific view of two things: why and where the market for agri-SME finance is and isn't clearing. If we start with the why, the large financing gap can be understood as a function of three factors, and I'm oversimplifying here, but essentially on the demand side, we've got limited investment readiness And on the supply side, you've got a series of issues around the product availability and the appropriateness of this product for the agri-SME. So how well the products are designed to meet the needs of agri-SME. And obviously, there's also a shortage of capital, there's not enough capital. What is also interesting is the where. And at a high level, what this analysis reveal is sort of, I would say, again, to simplify, slightly a three-tier market. At the top, you have a small set of high growth, high margin agri-SME that are transforming the market, such as, again, AgTech, and that are attracting funding from venture capital, private equity, or also, again, your commercial channels like commercial banks and non-banking financial institutions. In the middle, you've got a large middle of the market, a set of relatively mature SMEs that are experiencing moderate growth and that are currently being served primarily by commercial banks, and again, mostly in Asia, by non-bank financial institutions, and by impact fund with debt financing to support their ongoing growth and their ongoing operation and their gradual growth. And then you've got a very large bottom of the market. These are mostly a range of lower growth, a lot less mature and less profitable agri-SME, which are currently being served by public development banks, by social lenders, primarily with short-term finance, the likes of trade finance or working capital. And so at a simple level, the agri-SME finance agenda really aims to graduate agri-SME through these layers of finance. So using scarce subsidies in the sub-commercial market to grow them into more commercially viable prospects, and over time to grow them into fully commercially viable agri-SME. The reality is that obviously not all of the agri-SME will ever be able to make a complete graduation to the fully commercial capital. So that's an initial introduction really around why is this complex market not clear in full. Our initial premise really for the segmentation of the agri-SME rests on the segmentation we conducted with SAFIN. And the segmentation is based on two dimensions: the growth potential, how much can an agri-SME potentially grow, and the growth ambition, how much do they want to grow. And so essentially that yields 6 SME segments that range from SMEs that are about to transform the market with innovative business model, the likes of your high growth venture or niche venture, to your more traditional business model that are enabling the market, that are focusing on growing within the current system, all the way to your static enterprise. Typically those SMEs that you will find at the bottom of the market and that are hardly commercially sustainable at this point in time. The second thing we did is understanding these different pathways and understanding their goal for financing. We try to provide also a more dynamic view on the agri-SME needs. So at the highest level, we identify 3 needs for agri-SME in terms of access to finance. The first one, very simply put, is to sustain their current growth. So essentially finance their current sales cycles with working capital. The second objective is for them to accelerate their growth to their potential. So what this means is essentially investing into expanding their assets, buying a new processing plant, buying new land, or investing into the increase of productivity and the efficiency of their production processes and assets. And the third need that is equally, if not more important, is around adapting to a changing environment. And that's where we see 2 sub-needs, I would say, which are quite important. The first one, and partly true for these SMEs that are trying to transform the market, there's a need to invest into developing new product, new services, new business model. And then there's a a second need in terms of adaptation, which is building resilience. And building resilience in the face of a series of changes, but the most important one is obviously climate. And we're going to talk about that more at length in the section towards the end of the report. So these are the pathways, and essentially it allows us to understand which type of SME has a higher priority in terms of types of financing and in terms of types of products. Again, if I take a rapid examples, a high growth venture, the like of an Apollo Agriculture, or probably earlier in its sort of lifetime, an Apollo Agriculture has much more of a need for high risk equity in order to develop a new business model and to try and test and validate their product market fit. On the other hand, a much more static enterprise that is just trying to generate enough income for a household and maybe a couple of staff, a static SME will much more look at financing their sales cycle. So they'll be looking at working capital, but also they'll be looking at some subsidized funding in order to face the implication of climate and mitigate the impact on their production. So that's an element, that's how we sort of try to understand in a different way, to segment in a different way the agri-SME needs. And with that, what we've done is moving to the supply side of the agri-SME finance market. We unpacked the structure of the market from capital providers to financial service providers and to agri-SME. And based on our segmentation, we map the flow between the different channel of finance and the different types of agri-SME. And it reveals quite an interesting set of insights. And I'm only going to go through the key ones, but I strongly invite you maybe to look to that in much more detail. In the appendix of the report, you will see there's a lot more detail channel by channel. But essentially, your commercial banks tends to serve the broad middle of the market, from your sort of traditional SMEs that are experiencing moderate growth to your niche venture that are trying to innovate, but rarely will they serve your high growth venture. The MBFI equally tend to serve sort of the middle of the market, while your public development bank and also your social lender and impact-oriented fund will try to take a slightly broader view of the market. In particular, social lender and impact-oriented funds will fill critical gaps which are left open by large commercial and development banks. While they often have substantial agricultural expertise, they have also appropriate lending terms and have access to lower cost, they have a few limitations. The first thing is they don't have the in-country presence to service the loan effectively and to know in-depth how the different sort of local market operates. They don't have the capillarity or the presence in all the different rural areas. So as a result, they focus much more on dynamic venture and diversifying enterprises, which are active in high-value export crop. And finally, private equity and venture capital funder, as we said earlier, will mostly target private company, which are at specific stages of development and that can provide attractive risk-adjusted return. So typically those more mature SMEs that generate a large amount of cash flow and have a potential for growth, or these high growth, very innovative, very disruptive SMEs, what we call AgTech in our jargon. So essentially, this new segmentation of the demand on the one side, and in this mapping in more dynamic way of the flow between the different channel of finance and different types of SME, yields 5 key insights which are quite interesting to unpack. The first insight is that the small top of the market is, I would say, disproportionately and possibly adequately served. So they already have access to equity to an extent for some SMEs, but also all sorts of debt solution. If we look at the large bottom of the market, well, the first thing is that a lot of these SMEs will struggle to become investment ready. And obviously, as they're not investment ready, they are largely unserved by formal sources of finance. So this raises a serious long-term development question of like, how do we get most of them to become commercially sustainable? And if they're not able to sort of to do so, to become sustainably commercially sustainable, why and how should we still support these SMEs? And obviously there's probably an impact dimension, a social or environmental impact dimension to this. The third insight that's quite important is that there is a gap of equity for what they call the promising middle of the market. So a lot of the agri-SME in this middle of the market will also need to access what I call much more patient funding, either in the form of debt or equity, but partly equity, in order to invest into their own expansion, but also in order to invest in their own resilience. And there is quite a gap for agri-SME in this market. The fourth insight that's quite interesting is that there's a lot of movement, a lot of attraction, a lot of interest for this AgTech. So growth financing for more disruptive agri-SME is now an increasing target for many international funds, but it's still tough going. There are still areas, there are still elements within the funding journey of an agri-SME, within the growth journey of an AgTech, where there are a few gaps that need to be addressed. And the fifth insight, an important one, is that climate finance for agri-SME is yet to emerge as a strong channel of funding. So what we need there is not only supply of finance, but we need appropriate product, appropriate services, and in particular, these needs to be focused on adaptation for the agri-SME. But again, this is something we'll discuss a lot more at length in the next, in the last section around climate finance. So the first change priority for us that's really critical is about intentionally growing a large number of agri-SMEs into commercially investable prospects in order to anchor the local bank markets for finance. So why is that so? For viable local finance market to exist in the long term, what we need to have is a number of large, profitable and mature agri-SME that can anchor the market. And they'll have two roles. The first one is this agri-SME will play a role in organizing the market, for example, aggregating or processing produce from smaller farmers or smaller agri-SME. And the second role, so to say, is that they'll create a minimum, what I would say, base load, a minimum volume of transaction that can then be commercially and profitably served by local banks. So that's quite important for us to deepen the commercial layer of agri-SME. And we think this can be done through a series of three interventions. The first one is growing agri-SME within specific markets. So very simply put, and it's common sense, if the underlying agricultural markets are not growing, or worse, if they are contracting, it is very difficult for agri-SME to grow. Within the existing government and donor-led agricultural market development efforts, to identify those agri-SMEs that can really blossom, that really can grow into market leader and be an anchor for the market. And the objective is then to identify them and to design support around their specific needs. The second intervention for us is about closing the long-term debt and local equity financing gap. So for these SMEs to become mature, scaled, and robust agribusinesses, many of the top of the market agri-SME need access to, again, what I call patient capital. So long-term debt and equity to invest in their growth, their expansion, to invest in their resilience, and so on and so forth. And so there's an opportunity for DFIs to work with the likes of the local regional development banks and governments to structure this type of financing. And why is this collaboration with the local institution necessary? Because these local institutions have local insight and local knowledge, and again, this capillarity of the network, the presence in the different countries and regions. The third element is around, or third intervention, sorry, is around a more targeted government support and consistent agricultural development policy. As we know, the government position around trade, around taxation, special economic zone, and all the regulation. So this government position really can have a major impact on the emergence of these larger commercial agri-SME. So it's really incentivizing this government or rather its government policy and investment should really seek to intentionally support the growth of an increasing number of these SMEs to anchor the market for both agricultural commodities and agricultural finance. So what we don't do in this report is to go into the specifics as to which type of policy, etc. But what we refer is to a past ISF report that look into the macro, mezzo, and sort of micro interventions into these different types of markets. So these are the first three priorities: to grow a large number of agri-SME and really anchor the market. And the second change priority we recommend is around developing the capacity, the incentives, and infrastructure, again, for local bank and local funds to profitably serve smaller, less commercial agri-SME over time. So in the first one, we talk about the top ones, really that can anchor. Now we recommend for the local players to also make sure that they can serve this middle of the market, slightly less commercial SMEs. And why is that so? So we've noticed there's a lot of new international funds that have been set up over the last decade. And they've done a fantastic job in sort of plugging part of the gap, part of the supply need. But they also have a series of limitations in serving the majority of smaller, less commercial agri-SME. So, for instance, the large majority of these agri-SME required low-cost financing in local currency, and the local knowledge is needed to meet these needs. So, to develop this local capacity, it requires the use of subsidies in the short to medium term. But over time, the goal must really be to establish local finance that can sustainably serve this large middle of the market with less and less subsidy. So once again, the long-term government policy will be key to creating the incentives and to create the operating environment for local FSPs to make this transition. So how? Our report proposed three tactical initiatives to support that. The first one is around an increased local coordination and more effective investment intermediation. So really, what we need to realize is that for local financial institutions, local banks, local funds, developing an investment pipeline and priming investment is really a sort of complex task, a complex undertaking, and it's also labor intensive. And it's an opportunity for investors to invest more in intermediation, to double down on the current efforts, the likes of AGRA's investment hub or the USAID regional trade hubs. That's the first intervention. The second one is focused on intentional long-term subsidies. What we observe in the market is that many commercial banks have really enjoyed a rolling set of guarantees to try and increase their appetite for lending to the sector. But while subsidies are totally necessary, as we've seen, there's been rarely a very long-term strategy to use short-term lending to establish where subsidies are needed and where and when they can be scaled back. So again, it's being a bit more intentional in the use of subsidies with a long-term view of establishing markets that are sustainable commercially. And the third intervention that we see also very interesting is around the potential of AgTech. And what's interesting is a lot of the AgTech started typically as like marketplaces, platforms, but many more AgTechs are now considering expanding their services to the provision of financial services. And these AgTechs really hold great promise in a number of areas. They've got access to agri-SMEs, they've got access to smaller farmers, they've got access to data, and very often the capacity to process that data to develop different ways of doing credit scoring in order to unlock new financing products like asset finance, trade finance, or working capital for small farmers or other agri-SMEs using the service. So it is really an opportunity to keep supporting or even scale the support to this growing cadre of digital agri-entrepreneurs to develop this model, but also to make sure that they have access to appropriately priced capital to test and scale the product and the services that really works. Now, in this section, we want to talk about blended finance. And blended finance really play a key role in the agri-SME finance market to address the pain point and the bottleneck, both on the demand and on the supply side. And of all the channels we've discussed earlier in the previous section, all leverage some form of subsidies to mitigate the sort of real and the perceived risk of agri-SME lending. We use subsidies also to reduce the high cost of serving rural customers, and we use subsidies to address a series of other bottlenecks in clearing the market transaction. So for the agri-SME finance market to become more sophisticated and obviously to reduce the gap between the demand and the supply, it really depends on being, well, obviously a lot smarter on the use of subsidies and also on identifying clearer tiers within the sort of sub-commercial markets. And it's something that's very difficult to size, right? I mean, there were already questions around how did we size at the top level the different, the demand and the supply. So it's already a very difficult exercise at that level. So identifying specifically and quantifying that is difficult to understand the different tiers within the sub-commercial market. But broadly, the two ends of the spectrum are sort of relatively easy to understand. At the top, we have small to no amount of subsidies to reduce the risk and to increase the appetite of commercial financial service providers to lend to the sector. And then at the bottom of the market, that's where essentially we've got a larger amount of subsidies being used in order to support the development of a pipeline of, I would say, investment ready or quasi-investment ready agri-SME and reduce the cost of capital. So fully unpacking the approaches and the tier between these two is actually very difficult, as I mentioned. But for the sector to become more efficient and effective in the use of scarce subsidies, we believe it's quite important that we develop a more sophisticated way to benchmark the different approaches and model in terms of cost versus benefits. So what we've not done that here specifically, but what we've done is to provide a more sophisticated view, a more granular view on the landscape of blended finance. And what's interesting is that this landscape of blended finance approach has become a lot more sophisticated over the years. Capital providers and financial intermediaries are now a lot more nimble in trying to match the different investment profile of the agri-SMEs in terms of growth ambition, in terms of growth potential, in terms of profitability, value chain, risk exposure, and investment readiness. And what we have observed is that there are 7 key ways in which blended finance is structured to address the pain points of the market. Again, this will be explained at length in the report, but more and more approaches are being tried today than ever before. And what's interesting is that now there are also a series of combination of different approaches which are starting to address covariate constraints in a much more sophisticated way. So essentially combining, for example, risk share with technical assistance or incentive payments to essentially try and address a series of pain points, not just on the supply side or the demand side, but potentially on both ways. The issue right now in this sector is very much about the comparison between the efficiency of the different approach. It is something that's still very difficult to achieve. It's very difficult to benchmark. And we believe this is something that requires a much more specific learning agenda across the sector. So what we've observed is that many capital providers are supporting the development of specialized funds as a channel. And in doing so, they are really trying to pursue specific impact themes, such as gender inclusion or climate adaptation, and so on and so forth. And in 2017, we did a landscape at ISF, and we identify a number of key funds. So that's pretty familiar with a number of you. But we've updated that, and there are two trends that are really worth noting compared to that sort of 2017 edition. The first one is really the development of early stage venture fund. And we talked at length in the earlier section about that. But these funds are very much dedicated to supporting what we call niche or high growth venture. These are heavily concentrated in a small subset of countries. You will typically find them active in Kenya, in Nigeria and South Africa for Sub-Saharan Africa, in India, Singapore, and Indonesia for Southeast Asia. And supporting these innovative SMEs, as we mentioned, has really the potential to bring significant transformational change. For example, in broadening access to finance or facilitating the climate adaptation of smaller farmers. So that's really one of the first trends that's quite interesting. What we start seeing emerging is the presence of local or regional funds. So very few funds are currently set up and managed by local or regional teams. Very often they may lack the track record, they also lack the network with the capital providers, the DFIs, etc. But what's interesting is that they usually tend to have lower cost structures. They also have stronger local network, and they have deep market insights. So growing this local fund management capacity or establishing more locally embedded fund management teams is really an important step in refining the efficiency and the effectiveness of this channel. And finally, and again, we'll talk about climate finance more at length in the last section, despite a strong push for climate finance, very few funds at this point in time are currently intentionally fully focusing on agri-SME climate resilience. So that's something that's also quite important. And finally, what we did as well is interview a number of capital providers, of fund managers, or of ODA providers around, well, two things. So the role and the perceived positioning of these capital providers, but also around the current dynamics affecting the smart allocation of capital. And there are a couple of things that we probably all know of, but which are interesting reiterating. The first one is really that DFIs are the primary source of capital within blended finance, and they mostly operate with stringent mandates. They mostly operate with commercial expectations in terms of a return on capital. So they do not operate differently really from the private investors. If anything, they almost operate like commercial investors fully. The second insight linked to this is often that overseas development aid donors and philanthropic investors often provide a first tranche of catalytic capital to mobilize DFIs, or they are the first one to fund innovative blended finance structures. So an example was given in an interview with an impact investor a philanthropic family office in the US that provided the initial first loss tranche of $500,000 to de-risk DFC, the US development financial institution. So de-risk the actual US government. So quite an interesting anecdote. And then finally, what we observed is, and what themselves reported, is that when IFIs and DFIs innovate or take a more lenient approach to blended finance, they usually do so off their balance sheet. So they usually, do so off balance sheet, again, because of their expectation of commercial rate of return. So these are some of the key insights that really emerge from the interviews. Then there are a few elements around the dynamics affecting the allocation of capital that are quite important to mention. The first element is that, and we repeat that again and again also in a change priority, there is a lack of transparency at multiple levels, and this limits the scalability of blended finance. So transparency around the terms, around the investment strategy, around the mandates, and that really affects potential collaboration between different types of funders, or also financial service providers or fund manager in raising funding from the different DFIs. The second element is that the sector could benefit from increased collaboration, partially from the public capital providers, and where complementary exist, coordinated co-investments. And finally, what we have observed is that there's a large and repeated allocation of grants to traditional development or technical assistance program, but very often there's limited tracking of the efficiency in the use of funds. So it's a bit like they're on a repeat cycle without always fully assessing the efficiency. So this leads us to the third change priority, which is really around making blended finance more efficient and more effective. So there's a broader imperative to really get smarter about how scarce subsidies are structured and deployed globally, because they're really important to prime the market for agri-SME finance. And there are very few, very scarce public and philanthropic funds. So blended finance needs to be becoming a lot more effective and efficient. How to do that? So there are three interventions we propose. The first one is around developing a more sophisticated view of the market and a shared learning agenda. So over the last 10 years, we've observed that there have been a number of new approaches, resulting in a much more pluralistic funding landscape. But at the same time, what we also observe is that traditional approaches to blended finance are often on a repeating cycle. So there's really an opportunity for donors to sponsor a systematic long-term learning agenda that can test the efficiency and effectiveness of the different approach. So back to the point around the indicators, around the ability to benchmark the efficiency of these different channels. The second intervention is around catalyzing a new commitment by leading donors, DFIs, IFIs, and public development banks to become a lot more transparent, a lot more collaborative, and committed to smarter subsidies. So a lot of the capital providers and fund manager interviews express interest in coordinating their investment more actively with other institutions and in establishing more evidence to guide investment over time. So for this increased transparency, coordination, and learning really to be realized, what's necessary is that new forum for sharing need to be established between peers. And this could take a range of form, and it could be realized in more pragmatic co-investment mandate across institutional divides. It's also, again, a number of these recommendations, if not all of them, are repeat from exactly what Convergent also highlighted in its recent report. And the third intervention is around establishing more consistent taxonomies, data, and reporting requirements. So to get smarter about the development of those subsidies, there needs to be clear distinction between the different approaches and consistency in the data we collect. Then there is a need to establish new, commonly accepted classification systems, metrics, and reporting requirement in agri-SME finance. And this really could be driven by a range of specialized industry initiatives such as Ande, Mix, Agra, or GrowAsia, but it will require sustained donor commitment, and it should be linked to the learning agenda we mentioned earlier and to the capital market collaboration again that we mentioned earlier. Then the last section we want to talk about is around the state of agricultural climate finance. And what we know is well, there's been a lot of talk around climate and climate finance, particularly over the last few years. So agri-SME in the agricultural markets will be significantly affected by the climate change. And so for them, there are really three types of need, three types of challenges they're facing. There's a mitigation challenge, there's an adaptation challenge, and finally, that there is what we call nature-based solution. And I briefly want to talk about them, but the most important one is really adaptation. So mitigation is really about limiting the emission of greenhouse gases. And SMEs which are operating in the two regions that we focused on, Sub-Saharan Africa and Southeast Asia, more often than not have very limited contribution to greenhouse gas emission compared to their counterpart in the US, Europe, and so on and so forth, with the exception of obviously the livestock sector. But still, there would be a fraction compared to the livestock sector in the US, Europe, and Brazil, these large producers. So it's slightly less of relevance to them. They can contribute, but not as much as other players in other regions. Really, for them, what they'll face in terms of challenge is adapting to the consequences of climate change. And so they need to build the capacity to adapt and to prosper in the face of these shocks and in the face of long-term stresses caused by climate change. So that's the most important need for them. And finally, nature-based solution, it's more of an opportunity to invest into the protection and restoration of the ecosystem. And so more of an opportunity for them to potentially develop new models and new revenue streams. So with this understanding, really what we observe is that adaptation is the biggest need, but there is a significant dearth of capital. And to really mobilize that, what is necessary is an infrastructure to effectively finance these channels. And by infrastructure, we talk about, first of all, a clear taxonomy. So we need to make sure of what we talk about, a clear understanding of the solution. And we also need an infrastructure to develop a pipeline of investment and essentially have that pipeline reaching the different types of agri-SME with the right product and services. So there's also a need for expertise. So that overall infrastructure is at this point in time missing. If we size, and sorry, that's quite a busy chart, but if we try to understand what's the current supply of finance for tackling the climate changes, and that's essentially coming from a report by the Climate Policy Initiatives. So overall, there is close to $600 billion of total funding dedicated to global climate finance. But only 3% of that, barely $20 billion, is affected towards agriculture, forestry, and land use. And if we break that down further, 51% is allocated towards large-scale agriculture, and only 49% to the small-scale agriculture. So only 10 billion goes towards small-scale agriculture. And within these 10 billion, the bulk of it, as we know, is focused on adaptation, or a combination of adaptation and mitigation, because that's the most pressing. So essentially, it's very much a drop in the ocean. And if we look at the funding that then goes towards value chain actors, so agri-SME, it's only 7% of that. So we talk about $700 million. So these numbers are tiny compared to really what is needed, even compared to what is needed for agri-SME to sort of grow within the current context, but even more smaller compared to really their need when it comes to adaptation. And most of this current funding is currently coming from public sources. So 95% roughly of the global climate finance for small-scale agriculture is coming from public sources. So overall, that's a drop in the ocean. Sorry for this. And so the last priority, change priority, sorry, for us is really around building this infrastructure around climate finance. And over the next 5 years, what's really imperative is first to focus on 3 types of intervention. The first one is around developing new model and new taxonomies that can be used for investment strategies and for reporting. So it's really critical to establish a set of commonly agreed approach to achieve climate mitigation, adaptation, and nature-based solution goal. And this work will probably be achieved in parallel from many different angles, but international donors and DFIs really should step up alongside governments to help develop these standards and sponsor the complex technical work of applying them to specific agenda, such as agri-SME climate finance. So that's the first element. We need to talk the same language. And so we need we need new models and taxonomies. The second element is around the creation of a viable pipeline at scale. So what we advocate for is for large donors to invest in creating a viable pipeline. This research really reveals that there is a need for more agri-SME product and services solution within viable business model. So many of these new solutions will be completely new technologies. For example, developed by early stage ventures that are backed by the likes of the Nature's Conservancy's technology accelerator. Some other agri-SME will be at the forefront of innovating, but others will be a lot slower in adopting the solution. So what's really important, and donors have a significant role to play here, it's important to invest in both the early stage development and commercialization of climate solution, but also to invest in the expensive new intermediation that will be needed to channel these agri-SMEs into the portfolio of funders. So that's the sort of second intervention. And the third and last intervention that we really advocate is around expertise, integrating the climate expertise into all channels of agri-SME finance. All channels that we mentioned throughout this report have a role to play in supporting climate mitigation, adaptation, and nature positive response. It's not just the role of specialized funds, it's a role of local commercial banks as well, non-banking financial institutions, and so on and so forth. But very few of them have actual expertise to understand the climate-related agri-SME needs, to design products which are appropriate to meet these needs, and to channel the large volume of climate capital into viable financial offering. So bridge is really must be quickly built between traditionally siloed community of investment practitioner to really introduce this climate lens. So climate should be pervasive across all of these channels. It shouldn't be the preserve of specialized funds or specialized financial intermediaries. It should be spread across.
The CASA programme is proud to be building partnerships across the world to drive investment for climate-resilient agri-food systems and increase smallholder incomes. Visit the events page, past events section, to hear other expert viewpoints shared in the CASA 4x4s and webinar series.